Did you know that just checking how much mortgage you can afford by visiting a bank can actually drop your credit score, even if you are not ready to buy yet? And that's just one of the traps home buyers fall into. Now, here's the thing, most people, when they are just curious about buying a home, go straight to a bank to see how much they qualify for. The problem is that little visit can trigger a hard credit check, and your credit score can drop by up to 10 points. For a first time home buyer, those 10 points can really matter. Here's another big thing, banks will approve you to spend 39% or even more of your gross annual income on housing. But that's actually more than 52 to 55% of what you actually bring home after taxes. And what they don't even consider are your real life costs, like your actual housing utilities, home insurance, groceries, kids' activities, and your lifestyle expenses. That's how so many people end up becoming house poor. On paper, they qualify, but in reality, they struggle. And then, of course, the online calculators. One says you can afford this much, another says something completely different. Which one do you trust? That's exactly why I built my home buying planner. It's designed using Canadian mortgage standards. It considers all your real expenses and it gives you the facts you actually need, tells you your true affordability before you even start your home search. First of all, a big thank you to those who have already downloaded the home buying planner. You have taken the first step towards making an informed home buying decision. And here I'll show you how to get the best out of it. And if you are someone planning to buy a home in Canada soon and looking for clarity on your real housing affordability and the right budget, you are in the right place. So let's dive in and I'll show you exactly how it works. This planner comprises of 4 sheets. First is mortgage pre-approval calculator, then is affordability calculator, third one is amortization schedule, and fourth one is mortgage payment calculator. Let's start with the very first spreadsheet, that is mortgage pre-approval calculator. Before I start explaining how to use this calculator, two important things I want to mention. First, these spreadsheets are compatible both for the Windows and the Mac users. Second thing is this Excel sheet is protected to maintain the accuracy of built-in formulas and calculations, which means it will only allow you to input the values on the fields where it says enter values. By any chance, if you try to input the values where you are not allowed to, it will pop up this message, which means that you are trying to input the value in the wrong cell. Now let's start to see how to use this calculator. On the left hand side, it says enter value. So we are only going to put the values on these yellow highlighted areas. What this sheet helps you with, let's take an example that you want to buy a $750,000 home in Ontario and you want to know with the down payment that you have saved and with the interest rate that you will be getting from a bank, how much income would be required to buy that home. So this sheet will help you to know what is the income requirement to buy a home. These are the actual exact calculations which a bank will be doing. Why? Because this calculator is following all the Canadian mortgage standard rules. So I'll show you step by step how to use it. It's very easy to use. So I'll start from here. So first thing we are going to enter is the purchase price of the home that we are looking to get. So in this example, it's $750,000. So as soon as you enter the purchase price, on the right hand side, it is telling that $50,000 is the minimum down payment required to buy a $750,000 home. Okay, so now we'll come back to the next point, that is down payment. Here, we will be entering the down payment that we have saved to buy this house. Let's take an example that we have also saved $50,000 to buy this home. So I'll just put $50,000 over here and hit enter. As I hit enter, now on the right hand side, you can see that this calculator has done some further calculations for you. What the next calculation it has done is mortgage default insurance, which we also call it as CMHC insurance. When your down payment is less than 20%, you need to pay for an insurance premium. This insurance premium gets added to your mortgage required. So on the next option, you can see it is calculating how much is the total mortgage that would be required. How it is calculating it? It is calculating purchase price, that is $750,000 minus your down payment plus this mortgage default insurance premium. So the mortgage you will be requiring is $729,400. Now in the next option, we will be entering what the interest rate we will be getting from the bank. So next thing, what it is calculating in the very next column, if you see, it is calculating the stress test rate, that is 6.25%. So what it stress test is, Stress test is that when you are going to a bank or a lender to ask for a mortgage, they will make you qualify not on the actual rate you are getting from a bank, but on a rate that is higher than your contracted rate. How this rate has been achieved, that is your contracted rate plus 2% or 5.25%, whichever is higher. So 6.25% is higher, your mortgage payment would be $3,572.36. But the qualifying payment will be the higher payment of $4,453.23. Now, on the left hand side, the next thing we need to decide is amortization, like how many years we are taking this mortgage for. So you can go up to 30 years. Now, with the new rules, even the first time home buyers who are putting less than 20% down payment and those who are buying a newly built home can extend their amortization up to 30 years. Now, on the right hand side, we'll talk about the monthly housing cost. What happens is any bank or any lender, when you go them to get a mortgage, they only consider the property taxes and a minimum heating amount as your utilities for the house. So here in this column, it is automatically calculating the property taxes based upon the purchase price of the house. It is estimating 0.75% of the purchase price to be the property tax and $150 per month to be the heating cost. This is the same criteria that lenders use when you visit them to get a pre-approval. Now we again come to the left hand side. It is the monthly debt. So here you have to put what your monthly debts are. Like if you have any car loan, any student loan, if you are paying on a monthly basis, you have to enter an amount. Let's suppose you have a car loan payment of $500 a month. So you have to enter here. If you are buying any condominium, it comes with a maintenance and a condo fee. So you have to enter if there is any condo fee you will be paying when buying a home. Banks consider 50% only of this condo fee for qualifying you for a home. Now I'll just stop inputting any value till here. Based upon these inputs, that system is telling us that the minimum income required as per mortgage rules to get approved for this mortgage of $729,400 with your debt payment, you need an annual income of $157,821. Let's assume that we are making the same amount. I'm rounding it off to $158,000. So in this column, we have to input our income, what we are making on the annual basis. So I'm putting $158,000. So now we'll again come to the right hand side. It is now calculating GDS and TDS. What is gross debt service? Which means this is the percentage of your total housing expenses. This should be less than 39% as per the mortgage rules. And TDS is total debt service, means your housing expenses plus your any monthly debts that you are paying should be lesser than 44% as per the mortgage rules. So this is following the mortgage standards and giving you a figure of annual income that you require to approve for this mortgage is $157,821. But we have just mentioned that two things what banks are doing wrong. First of all, they are stretching your housing budget up to 39% of your gross income. They are not considering your net income. If you go by this, your housing budget will at least be 50 to 55% of your net take-home income. If you stretch yourself to pay this much out of your income on housing, then how will you survive on the other costs that you have to incur to run your life? And the other thing the banks are doing wrong is what we mentioned here, that banks are only considering limited utilities, that is your property taxes and heating cost, to make you eligible for this mortgage. There are other housing expenses also that you have to bear once you buy the home. Those are your hydro, like electricity, your water, and then there is important expenses of home insurance as well. So they are not considering those expenses in that thing. So if I add an average amount of hydro and water, assuming it to be $200 a month, and home insurance also you have to take, that let's suppose it's $200 a month, that's $400 of an additional cost which banks are missing when they are making you qualify. And second thing, they are collecting a higher percentage of slab of your income to spend towards the housing. So on the right hand side, if you see, it gives you ideal income required to avoid becoming house poor. How this figure has been calculated of $187,318 First thing it is considering is it is limiting your housing cost up to 30% of your gross income. And the second thing, it is taking into consideration not only the property taxes and heating, but also the full picture of your housing cost. That is your other utilities of hydro, water, and home insurance. So that if you have $187,000 of income, that's how you will be comfortably getting to afford a house of $750,000. So this is how this sheet is going to help you to know what is the ideal income required to buy a home. If you also want to check how much will be the ideal income required to buy a home that you're looking to get, you can also download this planner to make an informed decision. I have added the link of this planner in this description. You can also find the link of this planner in my bio. Now let's move to the next sheet, that is affordability calculator. So in the previous calculator, what was the purpose? That you have a purchase price in mind and you got to know that what is an ideal income required to buy that house. Now this affordability calculator does the opposite of that. You will be able to know that whatever your annual income is, your down payment saved, and the interest rate that you're getting, what will be the home that you can comfortably afford. So this sheet has two parts. One which you will be seeing on the front side when you will be downloading it, and when you scroll it down, this is the second part. Now I'll explain you how that works. This sheet also the same thing applies, that the cells have been logged to maintain the accuracy. Means it only allows you to make an input where it is required. So you have to make the inputs only in these yellow cells. Even if you try to make any changes by mistake on the other cells, it won't allow you to make the changes. So for the better understanding, I'm going to remove those figures which are already inputted. Okay, now I have removed all the inputs. Now let's start from the scratch. So on this column, you will be entering your household income. There was a question of one of the users that it only gives an option to enter only one income. What if I am buying a home along with the partner? So what you need to do is you need to add both the incomes. For example, if you are making $75,000 and your partner is also making $75,000, so combined together, which means your annual household income is $150,000. So here you will be inputting that annual income. So let's assume that we also have $150,000 of income. Now come to the down payment. Now you have to enter an amount which you have already saved as a down payment to buy your home. I'm assuming that we have saved $75,000 that we need to put as a down payment. Interest rate, I'm taking the same example that we are getting 4.25% as interest rate. We need to now select the amortization period. I'm selecting that I'm taking 25 years amortization in this case. Property taxes, you will be entering how much property taxes you will be paying for the property. So if you already have seen an MLS listing where you know that these are the property taxes for this property, you can input that. Or if you have an amount in the mind that you will be paying this much of property taxes per month, you just need to enter that. I am just assuming that we are going to pay around $300 per month as property taxes. Now here are the utilities. So we need to now consider all the utilities of the house, not only the property taxes and heating, which a lender considers to make you eligible for a mortgage. So that's the USP of this calculator, that this not only considers the limited utilities which a lender considers to make you eligible, but you can factor in all of your housing cost to see what your actual affordability will be to buy a house. I'm assuming that combined all together, my housing cost will be around $700 a month. Condo fee, if I am looking to buy a condo and if it has a condo fee, only then I'll be inputting that condo fee over here. Now we'll move to the next column just below that of monthly debts. Whatever your monthly debts are, any car loan, if your car is on lease, if you are having any line of credits where you are paying monthly payments, any credit cards, any student loans, you need to input those commitments over here. For this example, I'm just assuming that I have $500 as car loan. And just besides that, I can factor in all my living expenses, what my groceries, transportation, car insurance, all these necessary expenses, which I'm going to commit for each month. I'm just going to put an amount against that. So it says that my living expenses are $3,000 a month. You can input yours, what your expenses will look like. What other thing you need to enter here is your tax rate. So here we have inputted your gross annual income. Banks always calculate your eligibility on your gross income, not on your net income. But what is the idea here behind entering a tax rate is to let you look at the actual picture, what your housing expenses is going to look like if you buy this home. So here, just enter a tax rate, like how much taxes are you paying. Just enter your average tax rate, like how much taxes are getting deducted out of your income. I'm inputting 30% over here. So after inputting 30% here in this column, it will make a calculation that how much your net income per month will be after paying the taxes. So in this case, $8,750 will be your net take home pay. Now we'll move down to this important part of this affordability calculator. Based upon the inputs that we did over here, your income, down payment, interest rate, amortization, and your housing costs, plus your monthly debt commitment in the form of car loans and other loans, there are three scenarios that this affordability calculator will present it to you. One is maximum stretch, other is balanced budget, third is play it safe. This calculator is showing you that if you want to stretch your budget to the maximum, the purchase price can be $634,000 based upon your incomes and the down payment, interest rate, amortization that we have selected over here. If we make any change, then this will automatically change here as well. Just wanted to show you that if I select from 25 years to 30 years, look, 634,000 has now changed to $674,000 maximum. So just to show you that whatever the changes you are going to make on this part of the calculator, mainly this three section, then these figures will automatically change. So in the very first row, it is showing you the purchase price, which I have already mentioned. It is showing if you want to stretch your budget to the very maximum, that is $674,000. If you want it as a balanced budget, 623,000 should be the maximum price. And if you want to play it safe, keep it very safe, well within your affordability, $522,000 should be your maximum purchase price. The next thing it is calculating is the minimum down payment. This is not your down payment that you are looking to put. This is just for the information purpose. The calculator is calculating that based upon this purchase price, what is the minimum down payment requirement as per the minimum down payment requirement rules. So it is calculating that for $674,000 home, $42,400 is the minimum down payment. For 623, $37,300 is the minimum down payment. For $522,000, $27,200 is the minimum down payment. But how much we are inputting, we have already added that is $75,000. So don't just confuse it with that the minimum down payment that you need. You have already inputted that you are making $75,000 of down payment. This is just for an information sake to let you know that what is the minimum down payment requirement. In the very next row, it is calculating the CMHC premium. This CMHC premium, it is calculating based upon this down payment that you are inputting. The next thing it is calculating is mortgage required. So how it is calculating? It is calculating your purchase price, that is $674,000, minus your down payment, that is $75,000, plus this mortgage premium, that is $19,767. So that's how this figure of $618,767,000 mortgage is being calculated in this column and simultaneously in the other two columns as well. And now in the next row, on the basis of this mortgage and the rate of interest that you're getting, that is 4.25%, it is calculating what will be your monthly mortgage payment. And it is also showing you the comparison that if you go with a balanced budget option and play it safe option, what will be your mortgage payments in those options. Next is the qualifying payment. As we mentioned in the previous sheet, that bank makes you qualify not on the interest rate that you are getting from the bank, that is 4.25, but on a rate that is higher than that rate. So in this case, that minimum qualifying rate is 6.25%. So it is showing you what will be your qualifying payment. This is the GDS and TDS, which we already mentioned in the previous sheet. So in the maximum stretch, it is using the what lenders use as per the Canadian mortgage standards, that your total housing cost should be lesser than 39% and your total debt should be lesser than 44%. So if you follow the Canadian mortgage standards and the lenders, $674,000 is the maximum you should be buying the house for. The next option, which is balanced budget, it limits your total housing cost lesser than 36% of your gross annual income. That's how it is calculating the maximum purchase price to be $623,000, which is approximately $51,000 lesser than the maximum stretch option. And the third option, that is play it safe, it is considering your housing expenses to be around 30% of your gross annual income. So you can accommodate any emergency expenses and can also save for the future in the options like RRSPs and TFSs. And in the very last row, it is calculating what will be the approximately closing costs that you will be requiring to close that home. Obviously, you will be selecting that I want to go whether with maximum stretch, balanced budget, or play it safe. After that, we'll scroll it over and we'll come here to see what will be the impact of these scenarios on our monthly housing budget. So here it is asking you to select a scenario. So here is a drop down. Okay, so let's see that if I go with the maximum stretch. Okay, I'm selecting this maximum stretch. So here, if you see, it is making all the calculations on what we have already calculated is that after paying the taxes, our monthly net income will be around $8,750 minus living expenses of $3,000 with $500 of monthly debts. $1,000 we have already factored in all of our utilities, and our monthly mortgage would be $3,030.52. So see, when we selected this option of maximum stretch, it has automatically taken this $3,030.52 payment from this option and have copied here. Now with this option, we are looking at a cash balance, means whatever we will be left with after spending everything will be around $1,200 a month. If we change the scenario to the balance budget, so here it will also change the monthly payment. It will be picking what it has been calculated under this option, that is $2,772.50. So if we select this option, now we are left with a cash balance of around $1,500 a month. And if we select an option of play it safe, which means that we are looking to limit our purchase price to $522,000, now we are left with a cash balance of around $2,000, which is a very good saving per month after all the commitments of housing and our lifestyle expenses. So these are the scenarios that you can also run for yourself while checking your accurate affordability. If you also want to check what these three scenarios would be as per your income and your own down payment that you have saved, just download this planner now. The link is in the description. The same link is in my bio as well. Let's now come to the third sheet, that is advanced mortgage amortization schedule. This gives you the complete detailed breakdown of your mortgage, that how much interest and principal you're going to pay to your lender in a specified time. Plus, it will also help you to take control of your mortgage and lets you see the impact of prepayments on the mortgage and how you can become mortgage free early with the prepayments. So I'll show you how to use this planner. So again, we will only be making the inputs in the yellow highlighted cell and where it says and. So let's start with the very first cell, that is loan amount. So you will be entering your mortgage amount. Let's suppose your mortgage is $500,000. Interest rate, let's say it's 4.25%. Amortization, we are keeping at 25 years. Term means what contract we have entered in with the lender. So I'm assuming that we are taking a 5 years fixed rate or a variable rate mortgage. So here you will be entering the first payment date. As soon as you enter in this cell, it will give you the format in which you need to enter the date. That is month, date, and year. So I'm putting the today's date. Now, after these inputs, you can see on these cells, it is making all the detailed calculations for you. So what it is showing is the total payments. Means in 25 years, if you continue at this rate, $809,490 will be the total payments that you'll be making to your lender, out of which $309,490 will be your interest. Your last mortgage payment will be July 21st, 2050, and the number of payments are 300. And on the right hand side, it is giving you how much you will be paying to the bank in a term. So term here is 5 years. So these calculations are based upon 25 years amortization, and these are based upon the term that we have selected, that is 5 years, means our 5-year term will be ending in July 21st, 2030. So in the payment frequency, if you see, there is a drop down. So you can select other payment frequency that you want to set for your mortgage. If you go for accelerated bi-weekly or accelerated weekly payments, it will show you how much savings you will end up making, because when you are selecting a rapid or accelerated payment options, you end up paying one extra monthly payment each year towards a principal, which helps you to reduce your mortgage sooner, which results in interest savings and time savings. So when I select accelerated bi-weekly, I'll show you how these calculations will be made. So when I selected accelerated bi-weekly over here, so you can see in the middle, it has calculated that with the accelerated bi-weekly payments, we will be saving $44,589 in over 25 years. And the time we'll be saving is 3 years and 2 months, which means the 25 years mortgage we will be paying off in lesser than 22 years. So you can look at your own scenario by using this calculator that how much savings you will end up making if you switch to accelerated bi-weekly payment. On top of that, you can also see what will be the impact of prepayments on your mortgage. Just going back as a monthly payment over here, which right now it says with the monthly payment, I will not be making any saving. So let's assume that I want to make an extra payment of $300 on top of my mortgage payment each month. So I'll be inputting $300 first of all here. So it says enter an amount, I entered $300. So after that, if we are entering a figure here, we need to select the next option. What does it say? It says specifies the extra amount will be made every n payments. For example, if the payment frequency is monthly, enter 1 to make the extra payment every month. So as per this example, we want to make this payment every month. So we'll be clicking on the drop down and we'll be selecting 1 over here. So as soon as I selected 1 over here, you go back. So see in this amortization schedule, it has automatically applied $300 each month on top of your regular payments. So what will be the impact of these extra payment of $300? That you will be saving $56,131 in interest, and you will be paying off your mortgage 4 years earlier. So similar to that, assuming that I want to make this payment not monthly but quarterly, so I'll be selecting 3 instead of 1. So what will happen is, see, it is applying $300 each quarter towards the mortgage. So with these quarterly payments, your now interest savings will be $21,256. So if you want to change the frequency, you need to change the number here. I hope it's really easy to understand for you. Now I'm just erasing that and we'll move on to the next feature. So these two options will be used if you want to pay something regularly after a fixed interval. Now come to the third option, that is extra annual payments. Let's suppose you say that on top of my regular payments, each year I will be also adding $3,000 towards the mortgage. So you just need to enter $3,000 here and click enter. Now what will happen is this calculator will automatically apply this $3,000 after each year towards your mortgage. And here it will show that you will be saving $46,294 in total interest, and time that you'll be saving is 3 years and 4 months. Okay, I'm removing that to explain you the next feature. If you want to also add any customized payment in between on any particular month, you can also add in this by going into this amortization schedule. For example, assume that I will be getting a bonus next year in the month of January. So here on 31st January, I can easily put $4,000 towards the mortgage. So you can put 4,000 over here, hit enter, and it will show the impact of that prepayment towards the mortgage. So this is how this sheet is so important for the detailed bifurcation of your mortgage and helping you to see what the impact of your prepayments will be in paying off your mortgage early. So if you also want to make savings in the interest, just download this planner now. Link is in the description and in the bio. Fourth and the last sheet is for the mortgage payment calculator, which gives you the different payment options to pay your mortgage. So on the left hand side, it is providing you the loan amount, interest rate, and the amortization, which you have selected in the affordability calculator. So if you see in this play it saves scenario has been selected. So in this sheet also, whatever the mortgage required amount as per that scenario is, it is automatically taken that mortgage amount, interest rate, and amortization. So it is providing you the different payment options for this mortgage amount. Here you can compare the need to make the inputs to make a comparison of the payments for another mortgage amount. Let's say you want to see for $500,000 of mortgage, at 4.25%, what will be the mortgage payments. So here you can make a comparison of these two different mortgage amounts. So here's the truth. Relying only on a bank's approval is one of the biggest mistakes home buyers make, because lenders, as we explained, are not looking at the full picture of your expenses and the lifestyle costs, then just makes you look like eligible on the paper. And that can leave you stretched thin, house poor, and second guessing your decision after it's too late. But with this home buying planner, you are not guessing. You see the real numbers that matter to you, your lifestyle, your expenses, and what you can actually afford without stress. If you are also serious about buying a home, you can't afford to skip this step. Everyone who relies only on a bank's approval is setting themselves up for surprises. The people who use this planner, they walk into their home search with clarity, confidence, and control. So the question is, which buyer do you want to be? I hope you find this video very useful for your home buying search. Subscribe to my channel for more knowledgeable videos in the future. Thank you.